Picture this. You'll find a stock paying 20, maybe 30% a year in dividends. It looks like a dream. But in reality, it might be a trap that's already closing. Because when a dividend looks too good, it usually is. In this video, we'll uncover how those traps form and what most investors overlook until the damage is done. Let's unpack that. Alright, so here's what we're really doing in this video. We're not hyping any stock or promising magic returns. We're breaking down how dividend traps actually form, how to spot them early, and what practical numbers to watch. Every point you'll hear today comes from real data and historical examples. And just to be clear, this isn't financial advice. It's purely educational to help you understand the facts before you make your own decisions. Alright, let's get started. Chapter 1. Definitions and Essential Mechanics. Let's start simple. A dividend is a portion of a company's profits paid to shareholders. The most common metric you'll see is the dividend yield. It's just the annual dividend divided by the current share price. So if a stock pays $1 a year and trades at $20, that's a 5% yield. Easy, right? But here's where many people stop, and that's dangerous, because the yield only tells part of the story. The next number you need to know is the payout ratio. That's the percentage of earnings used to pay dividends. If a company earns $2 per share and pays $1 in dividends, the payout ratio is 50%. Sounds safe, but if it earns less than it pays, say $1 in earnings and $1.10 in dividends, that ratio jumps above 100%. That means the company is paying more than it makes. Some fund it with debt just to keep investors happy. That's not sustainable. Once you understand yield and payout ratio together, you start seeing why some great deals collapse fast. Chapter 2. How dividend traps form. The two distinct paths. Now, let's talk about how dividend traps actually form, because not all high yields are bad, but some are disasters waiting to happen. Path 1 is the less dangerous one. Here, a company simply pays a strong dividend and investors rush in. That buying pushes the share price higher, and the yield naturally falls back to normal levels. It's more about popularity than danger. Think of it as a short-term distortion. Usually, these companies have solid earnings, steady cash flow, and realistic payout ratios. The yield spike doesn't last long. But path 2, that's where most investors get trapped. Here, the dividend stays the same, but the stock price crashes. Suddenly, that same dollar dividend on a $2 stock shows a 50% yield. It looks like a once-in-a-lifetime deal. But in reality, the price fell for a reason. Maybe profits are shrinking, debt is rising, or management hasn't yet announced the cut everyone sees coming. So, investors rush in, hoping for quick income, and end up watching both their capital and dividend vanish. You can spot this pattern everywhere. Look at past collapses in finance or energy stocks. The dividend stayed stable right until the cut. Then prices fell even further. The truth is, a high yield created by a falling price is almost always a warning sign, not an opportunity. Understanding which path you're looking at can save your portfolio from a lot of pain. Chapter 3. Warning Signs Checklist you can apply now. Now, let's get practical. If you want to avoid falling for a dividend trap, here's a checklist you can actually use. Think of it like a quick scan you can do before buying any dividend stock. First, look at the payout ratio. If it's over 100%, stop right there. The company is paying more than it earns. Even 90% should make you cautious. The ideal range is usually under 75%. Next, check the yield against its industry peers. If everyone else is paying 3 or 4% and this one is offering 12, ask why. Sometimes it's because the price collapsed, not because profits suddenly grew. Then, study earnings and cash flow. Are they steady or falling? You want consistent profits and positive operating cash flow that comfortably covers the dividend. If the company needs loans to pay investors, ooh, that's a red flag. After that, review the balance sheet. Rising debt levels or borrowing fund dividends often signal future cuts. Also, take a look at the dividend history. Has the company paid reliably for at least 5 years? Have there been sudden suspensions or reductions? A stable history tells you a lot about management discipline. Finally, watch the stock's price action. If the yield stays extremely high for weeks while the market ignores it, that's usually a warning sign. The crowd might already know bad news is coming. If 3 or more of these signs appear, treat that stock as a potential trap. Remember, chasing the highest yield rarely ends well. Focus on stability, not excitement. Chapter 4. Short case studies that drive the point home. Let's see how this plays out in the real world. First, think back to Washington Mutual. Before its collapse, it offered a double-digit dividend yield. Many investors jumped in, thinking it was a golden deal. Within months, the dividend was suspended and the stock went to zero. The high yield was simply a symptom of falling prices and rising risk. Now, compare that with a more balanced example. MetLife once carried a payout ratio around 51%. Allstate, on the other hand, hovered near 110%. Both were large insurers, but one had a sustainable payout, while the other was paying more than it earned. Which one would you trust more long-term? Exactly. Here's another pattern we've seen again and again. A company's stock price drops sharply, yet management delays cutting the dividend. On paper, the yield looks amazing. In reality, it's a signal of distress. When the inevitable cut happens, investors lose both income and capital. These cases remind us that yield alone doesn't make an investment safe. In fact, sometimes the higher it goes, the louder the alarm bell should ring. Chapter 5. Practical step-by-step to avoid falling into the trap. Alright, so here's how you can protect yourself, step by step. Step 1. Start with the payout ratio. If it's above 75%, dig deeper. Over 100%? Move on. Step 2. Compare the yield to the industry average. If it looks way too good, there's probably a reason. Step 3. Check earnings and cash flow for at least 4 quarters. You want to see that dividends are paid from actual cash, not borrowed money. Step 4. Look at debt levels. A company that's increasing its debt just to maintain dividends is walking on thin ice. Step 5. Review dividend history. Has it been consistent? Did the company keep or cut dividends during tough markets? Reliable payers stand out. Step 6. Understand the business model. Do you know how the company makes money? Does it have a lasting advantage? If you can't explain it simply, you probably shouldn't invest yet. Finally, Step 7. Limit your exposure. No single stock should make or break your income plan. Diversify across sectors and keep cash flexibility. Following these steps won't guarantee profits, but they can keep you away from most dividend traps. Think of it as a routine safety check before you invest. So, what did we learn? High dividend yields can come from 2 paths: solid business growth or collapsing prices. The key is knowing which one you're looking at. Check payout ratios, cash flow coverage, and how that yield compares to peers. These simple numbers tell you more than any marketing headline ever will. Remember, sometimes the biggest returns come from the dividends you don't chase. If you found this breakdown useful, drop a comment below with a stock you want analyzed next. And don't forget, this is education, not financial advice.